The low correlation between our stocks and our 10-stock portfolio led to a diversification benefit where we got less than average risk even though we got average return. By forming the portfolio, effectively what we did was we got rid of a lot of the idiosyncrasies, the individual movements of the stocks, the stock-specific risk, and we're left with just the overall portfolio risk. The capital asset pricing model is a model that relates the returns to risk in a well-diversified portfolio. If we think about forming a portfolio, and let's just consider the case where we had a group of average risk stocks and they had average correlations with one another, so say 0.6, 0.7, somewhere in that range. That's the average correlation of all stocks in the market. And we were to plot what would happen to portfolio risk on the vertical axis, and on the horizontal axis the number of assets in a portfolio. So if we only had just one stock, it wouldn't be much of a portfolio, right? The riskiness of that portfolio would be the same as the riskiness of that individual stock, that standard deviation of that individual stock. But as we add more and more stocks to our portfolio, say when we add 5 stocks to our portfolio, we see that the risk or the standard deviation of that portfolio drops substantially. And then if we went out to 10 stocks in our portfolio, we would see again that we had a reduction in the risk, our diversification benefit, but that this reduction in risk from 5 to 10 stocks is smaller than the diversification benefit that we got when we went from 1 to 5 stocks. So as we say add 15 stocks to our portfolio, again, we get a diversification benefit. We see that as we add more and more stocks to our portfolio, we're getting a diversification benefit, but that diversification benefit is getting smaller and smaller as we add more and more stocks to our portfolio. Now, when we get out to 20, 25, 30, 40, 50 stocks in a portfolio, we get rid of almost all this risk that we can get rid of, but we're still going to have some risk that's left over. The risk that's left over is simply risk that we cannot get rid of. And what risk can we not get rid of? We cannot get rid of market risk, because most stocks have some exposure to the economy. Now, we can have stocks that have low market risk that don't seem to be affected by too much what's going on in the economy, and then we can have stocks that have lots of market risk. In other words, they're highly sensitive to what goes on in the market. But in any case, when we form a portfolio that has, say, more than 20 to 30 stocks in it, we've gotten rid of most of the individual company risk that we can get rid of. And that risk that we can get rid of, we call that diversifiable risk. In other words, we can get rid of the risk of company A and company B that's not related to the market simply by forming a portfolio. And then once we form a portfolio, I think if you have a portfolio of, say, 30 stocks, do you really care about what's going on in any one stock? No. What you care about is what's happening to the overall portfolio. But there's going to be some measure of risk that you can't get rid of. And we call that market risk, systematic risk, and non-diversifiable risk. Well, if by forming a portfolio we're able to get rid of this diversifiable or company-specific risk, we can't expect to get rewarded for doing that because, gosh, it's easy to do that. How easy is it to do it? Go buy a mutual fund. If you buy a mutual fund, you're getting diversification. You're getting rid of all that diversifiable risk, and what's left over is the non-diversifiable risk. So if investors can get rid of diversifiable risk very easy, we can't expect to be rewarded for diversifiable risk. We're only going to be rewarded for the risk that we take on, that non-diversifiable risk. And the capital asset pricing model relates the expected and required returns on individual assets to this non-diversifiable risk, this market risk. Now, when we're looking at the capital asset pricing model and it's coming up with a measure of non-diversifiable risk and the expected returns, keep in mind that we're doing that in the context of a well-diversified portfolio. In other words, we have 20, 30, 40 stocks in this portfolio, so we've gotten rid of all the diversifiable risk. Because the capital asset pricing model does not measure diversifiable risk. It only measures non-diversifiable risk. So you can look at the definitions for total risk, diversifiable risk, and non-diversifiable risk in the text. capital asset pricing model is a very basic theory that links risk and return for all assets. And that's key that we recognize that this is a theory. We're not saying that it completely explains all returns all the time. But what it does is it quantifies the relationship between risk and return. In other words, it measures how much additional return investors should expect from taking a little extra risk. The capital asset pricing model uses something called beta as a measure of non-diversifiable risk. And what beta captures is how sensitive a stock's returns are to the return of the market. And we can use historical returns to estimate an asset's beta coefficient from historical data. Keep in mind, though, when we make investments, we care about future returns, and it's really difficult to estimate a future beta, but we can look at historical returns to calculate the asset's beta coefficient, and studies have shown that that's a reasonable thing to do, because usually historical betas are very highly correlated with future betas. So in other words, it's a pretty good proxy. Now, the beta coefficient for the entire market equals 1. So the average stock has a beta of 1 because the market captures the returns of the average stock. And we view all companies' betas in relation to this value of 1. And just to kind of clarify, we're looking at the correlation with the market return. And the market return is the return on the market portfolio of all traded securities. So we're not talking just stocks, but all traded securities. This would be stocks, bonds, domestic stocks, international stocks, and so forth. So, if we have a beta greater than 1, we say that, well, okay, usually there's a tendency for that stock returns to move in the same direction as the market return. And if we had a beta of 2, we would say this stock is twice as sensitive to the market as the average stock. If we had a beta of 1, we would say this stock is about as sensitive to the market as the average stock. And if we had a beta of 0.5, we would say this stock is only half as sensitive to the market return as the average stock. And of course, if we had a beta equal to 0, we would say that it's unaffected by the market at all. There's no relation. An example of that would be a treasury bill. It's not really affected by the stock market because if it promises it's going to pay 4% per year, U.S. Treasuries never defaulted, it's going to pay 4% per year. And then if we have negative betas, the stock tends to move in an opposite direction to the market. So, for example, if we had a beta of a negative 0.2, it moved in an opposite direction to the market, but it was twice as sensitive, or twice the sensitivity is twice as much. The capital asset pricing model uses beta to estimate the risk premium for an individual asset. So, the capital asset pricing model says an investor should expect to get the risk-free rate plus a risk premium. And we measure the risk premium for an individual stock by looking at the stock's beta multiplied by what we have here, the return on the market less the risk-free rate. We call that the market risk premium. And I know my handwriting is terrible, gentlemen and ladies, but I can't do anything about it. The risk-free rate of return. This is a required return on a risk-free asset, typically a U.S. Treasury, and the risk premium, the difference between the market return and the risk-free rate, is called the market risk premium because it represents the premium an investor must receive for taking on an average amount of risk associated with holding the market portfolio of assets.